With the market growing a little more tepid after a furious advance, Dow sinking 40 points, S&P inching up 0.1%, NASDAQ inching up 0.08%. It's the perfect day to answer a question I hear endlessly. Hey, why own anything else when you could just own the Magnificent Seven? Why bother with a drug stock, an industrial bank, when you could have just bought one of these highly visible winners? There's a simple answer, and that is diversification. You never really know what's going to work in advance, so you need to spread your bets across multiple sectors. Last year, for example, the Magnificent Seven were terrible performers. You'd be kicking yourself if you owned all of them and nothing else. But there is another reason, and this has to do with something that you and I have to work on. It's how difficult it is to own high-quality stocks, how difficult it is to stay long, so to speak, especially if you listen to the whamma-jamma pros, the researchers, and the traders. There's a phalanx of experts that are literally out there to get you to trade, to get you to sell. How else will they stay relevant? The bias is to get in and get out, regardless of how good the underlying companies might be, which is why these 7 stocks are among the most heavily traded in the business. I think owning these stocks through the gauntlet of Wall Street, is a Herculean task. So let's go over what might have kept you from holding the Magnificent Seven and making big money this year. I'm going to use the charts to demonstrate how difficult it really was to get to the promised land of the higher prices. Perhaps it'll remind you to hold on to them or buy them back in the weakness when you actually see the visual, the pictorial.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.